Hi folks, this is RAJAT Bose from Kolkata. Welcome back. Today we are going to discuss something that will help the traders. First steps towards becoming a successful trader. I have been a technical analyst as well as I have guided so many traders in the market. So catering to their demand, I have come up with this video. We will be describing the main points here, not too much elaboration, but definitely there will be very important points. Now we are beginning. What are the steps to take to become a successful trader? First of all, I would like to tell you one thing. Do not be undercapitalized. Rather, please be adequately capitalized. What do I mean by that? What I mean is this, that in order to trade in the market, if you are a trader in the stock market, if you are a trader in the commodities market, you require a certain amount of capital. Of course, some of you might have read about Richard Dennis, who started with $500 and finally went on to make $2 million. That kind of stories are there. Richard Dennis is a legend, but those things are no longer possible because of the complexities in the market, and this is a market where the margin requirements compel you to have some adequate capital. So in my view, if you are trading in the stock market and if you are trading in the F&O segment, unless you are really very highly capitalized, it would not be worth your while to actually trade in the futures segment. It would become very clear as to why I say that. A minimum of 10 lakhs to 12 lakhs you would require as capital to start trading in the futures segment. And if you trade in the cash segment, then you can start with a smaller capital. But remember one thing, that you must have the ability to actually take a number of trades that can go adverse, and you have to contend with it. So be certain about one thing. However skilled you are, whatever methods that you are using and whatever plans that you have, trading plans or whatever, unless you are adequately capitalized, you would not be able to succeed in the stock market or in the commodities market or any market where you are actually trading at least some large sums of money. I mean, especially the contract size might become pretty big. So decide before you take into trading. It is very easy to think that you would trade with a small amount and then become successful, but that hardly happens. Actually, most people lose their money and leave the market. Well, now I would emphasize on choosing your time frame. What I have seen is that everybody wants to become a day trader. Let me tell you just one simple thing. This is the most difficult trading activity that one can envisage. It sounds great that you are becoming a day trader, but actually day trading is the most difficult thing to do. You can be a swing trader, you can be a positional trader, but you to become a day trader, first of all, lot of people have this misconception that a day trader is a trader who trades on a daily basis. No, a day trader is a trader who actually closes his or her positions at the end of the day. They do not take any trade home. But the probability of your succeeding as a day trader is very, very small. 1 out of 10,000, that is 0.01% of day traders succeed in making money. So you can think of, if you decide to become a day trader, you have to be very, very good. And to start as a day trader is actually a surefire way of losing money, because you will not be able to close your positions, you might carry losses, all those things will happen. So choose your time frame of trading deliberately, that whether you will become a day trader or you are becoming a swing trader or you are a positional trader. And finally, there is a thing called long-term trader. Who is a long-term trader? We have heard about long-term investing. Now I need to tell you that who is a trader and who is an investor. A person who actually buys a stock and continues to hold it for 1 year or even 1.5 years, 2 years. Initially, he or she started with a position thinking of he will continue for say a month or 2 months or so, but later on, because the position turned adverse and she or he was losing money, carried it forward. So ideally the situation is, the moment you actually fixated, the traders are fixated on a particular price point to exit, and they have stop losses, that also is a fixed price point. So if you are betting on a price to come when you will exit your position with profit or whatever, or losses as the case may be, then you are a trader. Then who is an investor? Even if you hold a stock for 5 years, but you are fixated, say you have bought at 100 and you are planning to get out at 350, 400, whatever be that, you're still a trader. You are not an investor. An investor is a person who bets on the company's business, studies the business, then takes a position, and only when it actually shows the kind of expectation, business expectation, sales growth, profit growth and other things, and then the price unfolds, a certain level comes when he decides to take some profits, that person is an investor. So long-term traders are long-term traders by default. They do not plan to become long-term traders, unless of course you are James Chanos, who could actually take real short positions, or a Michael Burry. We are not Michael Burrys or Jim Chanos, so let us not talk about long-term traders. But initially, in my view, if you start becoming a positional trader, taking delivery of your position, I think you would do much better. And in that case, you have to actually bank on the long side. That is the thing. So let us be very clear that if you become a day trader, you should be very careful that you are not carrying any position overnight, and you should have very fixed stop losses and targets. Accordingly, you should trade, but that's definitely not something that I would recommend for a beginner. Well, you must remember one thing. As a trader, you would be better off if you choose only one counter to trade. Say you choose a Nifty or a BankNifty and you are trading options or you are trading futures, or at the most you can go up to 5 counters. Why I tell you? Because if you think that you can actually trade n number of counters, or any counter for that matter, when we trade we call stocks a counter, stocks or a particular instrument like a futures as counters. So you cannot possibly study too many counters at a time. In fact, if you are a serious trader who would actually do a lot of studies in the evening or in the night, you cannot go beyond 5 counters. If you do, that means your study is not properly complete, and later on you will have problems managing all those positions. So I know there are people who are actually index traders. They trade the S&P 500 in the US, they trade Nifty or they trade BankNifty. I know a very successful trader personally who is a BankNifty options trader. So you have to choose, and my suggestion of course would be to trade an index. It is much better to trade an index because it is not so easily manipulated. But if you have preference for a particular counter, that's a particular stock, say maybe Reliance Industries or say some other stock like, but whatever stock you choose, that stock must be very liquid and it doesn't suffer from any kind of impact cost, in the sense that it is an illiquid counter. So when you try to exit, the spread becomes higher and all that. That's why I suggest either you go for indices, I mean Nifty, BankNifty, or you go for very liquid stocks. So you need to choose, but do not try to study more than 5 counters at a time, and it would be better if you can bring it down to 1 or 2 counters where you would specialize to become a professional. To be a professional trader, you actually should have very few counters that you dabble in. A lot of people have misconception about one thing, that if you can be a very good technical analyst, or if you can actually read macro fundamentals, blah blah blah, and then you can become a very good trader. It's not that at all. In fact, you will be surprised to hear that some of the best analysts are horrible traders. They actually can't manage both. That's why in Wall Street they say that you are either an analyst or a trader, and yours truly, you all know that I am an analyst. I have been a card-carrying technical analyst, but I also do fundamentals. I have guided, I have helped a lot of traders. I know what kind of problems they face. I know why they don't succeed and why do they succeed, all that. That's why I'm telling you this, that the biggest asset for a trader is developing a proper trader mindset. What is that proper trader mindset? The proper trader mindset, by the way, this actually is your best age. They call it EDGE. I mean, this age, sometimes they say that your age comes from your system build-up or your kind of technical analysis that you do. But my feeling is that this trader's age comes first through your acceptance of risk. Risk acceptance, very few traders have. When I say that you have a stop loss and you have a particular target and you are taking a trade, there is an entry point and all that, this is easy, yes. But the fact that you have actually fixed a stop loss, you know that the stop loss can be hit at any point in time. But truly speaking, you know, very few traders can accept that the stop loss will be hit and there will be some losses because of that trade. This happens because most traders fail to understand one thing, that the trading losses are actually an expense, and trading should be viewed as a business and not as a particular activity. It is not kind of gambling or something. It is a very well thought out, well executed practice that you are going to do. So you need to have that proper trader mindset. You will consider that you have actually developed that kind of a trader mindset where your risk acceptance is 100%. That means that either some bad news or good news will not make you feel elated, and bad news you will not get depressed, because you know, they say that a trader should be poker faced. Poker faced means those who play poker, you won't be able to understand whether they are feeling good or feeling bad. They have an expressionless face. That means any kind of adverse situation or any kind of situation that gives him or her a bounty do not affect them at all. This is the most important thing. And how can you achieve it? When your risk acceptance is 100%. If you can't accept risk properly, then fully, not properly. If you can't accept risk fully, then you will suffer from that depression or elation. It is not the sign of a professional trader. And as a professional trader, you have to understand that you are betting, you are in a situation where the outcome is completely random. When the outcome is random, anything can happen and your stop loss can be hit for any reason. For any reason. You never know that some kind of a news may come and immediately there is a slide or there is a sharp upswing, you have a short position, you get your stop gets hit or something. So it is not, don't ever think that you are being able to judge it beforehand so well that you are actually the trade succeeds because of you. No, not at all. Trade succeeds, yes, you have an edge, your studies might provide that edge, but still, unless you accept, why am I emphasizing on this random nature of trade? If you understand that this whole thing is very random, you will not do one thing. What you will not do? You will not blame yourself for an adverse situation. Because if it is random, if the outcome is truly random, if you really believe that, then how can you blame yourself? And the worst thing that a trader can do is to blame herself or himself, and that will affect the subsequent trades. And to succeed, very soon we will understand as to why our success depends on our ability to take trades continuously. That's why I emphasized on adequate capital, and also I would say that there is another reason why you should be able to take trade on a consistent basis irrespective of the outcome. If we accept that the outcome of every trade is random, then we must embrace thinking probabilistically. Thinking probabilistically, I have learnt it from a famous coach. Of course, I haven't taken any courses under him, Mark Douglas. Mark Douglas is no more, but he wrote 2 great books, Disciplined Trader and Trading in the Zone. So Mark Douglas says that thinking probabilistically, if you think probabilistically, then you are actually in a situation where you can contend with losses and continue to trade. What is thinking probabilistically in the market? In a situation where you find that there is a risk of loss and there is so much of so many issues that you may actually get emotionally upset, you may lose your capital, and then yet I'm telling you to think probabilistically. Thinking probabilistically, it is just consider the players in the casino. What do they do? Actually, the players who make money in a casino are those people who come to play the casino's game early evening and they continue till late hours in the evening or very close to morning when they end. In between, they take many bets, and what do they know? They know one thing. They know one thing, that is, over a number of trades, the net position will be positive for them. Do you know that even the casino players know that these people will make money? These people will make money, and even the casino players sometimes celebrate them because they are the lure for others to come, but those who are not professional gamblers or casino players would not be playing like that. So just think, you are thinking probabilistically in the sense that, say, suppose you are taking 20-30 bets at a time, and then the net result should be positive. So you are not bothered in some trade you are losing, in some trade you are gaining, because you have already predetermined what would be your stop loss. How much money you are losing on a trade, you have already predetermined. This is another characteristic that you must remember, that predefine your losses. What would be the quantum of loss that you will take in a trade? That must be fixed. But be prepared to carry on trading even if you lose 5 bets in a row, 7 bets in a row. I would say, Mark Douglas says you should be prepared for 30 bets in a row. Even if you lose, you should continue. That's the reason why I said that you must have adequate capital. Otherwise, you are not going to win the trading game. Those who feel that they will take 2 or 3 trades and then they will make money, most of these people actually lose money, and those people who are professional traders, they take away the loser's money. So remember one thing, remember to think probabilistically. Probabilistically, I am saying that is, you are betting on a probability that based on your kind of understanding, your kind of system that you have developed, or your setup that you have developed over a period of several trades, you will definitely make money. Do you know that the algos actually lose a lot of trades? But net in an algo, you will find that 1200 trades have taken place during, say, 6 hours time, and in that they actually net make money even after brokerages and all that. So algo also thinks probabilistically, and if you have to succeed, you also have to think probabilistically, that over a period of this run of several trades you will make money, but not in one trade or two trade or three trades. So think probabilistically and predetermine your losses. These are the steps that you need to keep in mind very strongly. Develop an edge. That is a very important thing. Your edge may come from your, as I said, that initially it should be whatever edge you develop, that is, you have a very good system, or you have a lot of capital, you have an enormous amount of capital. Mostly that will not be the case, but one edge that you must have is your right kind of temperament. To succeed as an investor, you require right temperament, as Warren Buffett said, and to succeed in trading, Mark Douglas says that you must have the right kind of temperament. What is the temperament? That mindset that you may lose one trade, two trade, but over a period of several trades you will actually come out winner. That is the basic thing that you need to develop. Apart, how will you be so sure that probability will be on your side? Because while studying either one counter or 5 counters, you must have studied them so well that you know that the system that you are following, or the indicator, or whatever signals that you are following, you are actually doing the right thing, because it has shown that the net outcome is always favorable and positive. That's why you are employing that kind of a trading strategy in the market. If you trade on the basis of tips or something, then there is no edge. The edge comes from your source of information, and that may do well, may not do well. Actually, those are for the amateurs. If you want to become a professional trader, you have to have your own edge. But remember one thing, that edge may come from some study, but before that you have to develop the proper trader mindset, where you will think probabilistically and you would not be upset by any kind of adverse or favorable development. So take time, devote your energies to develop that edge, whatever be that, but develop that edge that will actually put you in the right stream of action. Cut your losses short. I already said that predetermine your losses. Cut your losses short because you are putting a stop loss, and the stop loss should not be cancelled. There is a thing called good till cancelled, but if it comes to your stop loss level, then you actually cancel it, or you do not implement it. Do not do that. That means you need a discipline also to cut your losses short. If you can't cut your losses short, however much a great trader you try to become, you will not succeed, because preserving your capital is as important as it is in investing. That you should not lose money. In trading, losses will be there. In investments, maybe you can limit your losses to a great extent by choosing it properly and things like that. But in trading, since the outcome is random, there will be losses, but you should actually cut your losses short by maintaining your discipline and predetermine that this is the level. If it were to come, then I will exit. And if you are not comfortable with the stop loss that you have actually placed, then don't take the trade at all. A corollary that follows is that cut your losses short, but let your profits run. You would say that this is so easy. I'm actually in profit, so let's carry on. No, it is not that easy. Mr. Market will actually give you a hell lot of trouble. Suppose you have taken a position at 107 and your target is about 120. After reaching say about 114, it actually claws back. By the time it comes to 110, you start developing doubts and you are actually getting out. This is a problem. This is a problem. Well, sometimes it is actually better to get out taking a small hit or taking very little profit, because the logic of the trade has actually overturned or it is no longer valid. Then you get out. That is actually the right thing to do. But if because it is showing some kind of reverse action on the downside or on the upside, whatever the case may be, if you exit, then it will happen. But despite me warning you about let your profits run, do not bother with this, that your profit should be maintained, you should continuously. Sometimes people use trailing stop loss. If you do trailing stop loss, sometimes your trailing stop loss might be hit, and if that trailing stop loss is hit, you are out fine. But sometimes it may so happen that after hitting your trailing stop loss, the stock goes on to climb higher and higher, or if it is a short position, going down and down. Those things might happen, but you have to accept it certain times. Initially, be certain about one thing, that there will be such situations when you will not be able to execute the trade at the right time, or when the profit was to be taken, that you had not been taken. Those things will happen. Don't get upset and don't try to blame yourself. I have been receiving a lot of comments, not just through YouTube comments, but also in WhatsApp, in Facebook, other places, through also on telephone, and I am trying to incorporate them. Continue watching my videos. If you like them, press the like button, subscribe to my channel, and also do not forget to press the bell button.